Hello everyone. This is the second video on Berkshire Hathaway, and we will talk about its business model in detail. Let's start with the question, what is Berkshire? Some people would say that it's an equity fund managed by Warren Buffett. And it is true that Warren Buffett started his career as a stock investor, and also when he took control of Berkshire, he focused on equity investing. However, the equity portfolio is currently only about 20% of Berkshire's total value. And as you will see today, its public equity holdings is a very small portion of its overall business, so this answer can be only partially correct. Another person would say that Berkshire is an insurance company. And it's true that Berkshire is one of the largest insurance company in the world right now, and it creates huge amount of money that the company can invest. However, the profit from insurance is only about 6% of Berkshire's total profit, and a lot more cash is created from other parts of its business. So again, it's true that Berkshire is an insurance company, but this doesn't describe the whole picture. Another person would say that Berkshire is made through multiple M&As, and it's a holding company that controls dozens of companies. And it's true that Berkshire is created by acquiring dozens of companies throughout the years. However, it's very different from private equity funds that generate profit by investing in and selling companies constantly. Also, Berkshire does much more than just being a holding company of various assets. For example, on top of dozens of industrial and retail companies, Berkshire also controls very large utilities. So the point I'm trying to make here is that it's true that the Berkshire can be described in these ways, but we need to look at the whole picture in order to understand and especially to calculate the correct intrinsic value of the company. So today we'll talk about each of these businesses, starting with the equity portfolio. This was very important, especially in the early days, and even before Buffett acquiring Berkshire. He ran a partnership where he generated for about 10 years average return of 31.7% per year, compared to the Dow's 9.1% performance during the same period. So he generated 22.5% of alpha for over 10 years. This is obviously very good performance, and similarly, his partner Munger also ran his fund for about 10 years. His CAGR was 19.8%, which is much higher than the index performance during that period, which was 5%. So both Buffett and Munger generated very high returns even before they joined Berkshire. And after they took control of the company, their performance in the first 30 years is very, very good. During these 30 years, there were many years when they generated over 50%, and in 3 occasions, they even generated performance that's higher than 90 to 100%, just in a single year. However, if you look at the second half, which is recent 30 years, the performance above 50% ended in 1998. And more recently, there were only 2 occasions where they generated near 30% return. But in both of these cases, the market also generated return that's close to 30%. So their alpha is definitely decreasing. And these pictures show the total value of the company. But let's look at just the purely equity portfolio performance of the recent 25 years. Here we can see that close to the 2008 financial crisis, Berkshire's equity portfolio still generated some alpha. However, more recently, this alpha is definitely decreasing. To look at this alpha decay post-GFC in a visual manner, let's look at this graph showing 10-year rolling alpha of Berkshire's equity portfolio. We can see very good performance in the first half of Berkshire compared to the second half, where it is barely beating the market. This is also true if we look at the 5-year rolling data, and there seems to be 2 main reasons for this. First is the equity portfolio is becoming very, very big. As we can see here, by 2013, the company's portfolio became larger than $100 billion. And this is the point where the alpha generation seems to have disappeared. And this is troublesome because the equity portfolio size continues to get bigger. So this size problem will remain with Berkshire forever. The second reason seems to be that starting in 2010s, very high values were generated by tech companies. However, it's well known that Buffett's one of the biggest weaknesses is his passive attitude towards technology companies. Even though he made some good bets, especially with Apple, this weakness definitely contributed to the underperformance in recent years. So basically, we cannot expect this high return that Buffett generated in the past to be repeated in the future, probably forever. So let's look at the 3 key takeaways. First is, as we mentioned, that we can only expect about market-like return in Berkshire's large portfolio. Second takeaway is that because the equity portfolio is filled with value stocks, and also Berkshire holds a large pile of cash that can be deployed in any time, Berkshire's equity portfolio shines during market panic. As we can see here, Whenever market falls significantly or even stalls its growth for several years, like during these periods, Berkshire's alpha definitely increases. And even during 2020 COVID crisis, Buffett made the mistake of not betting big during the downturn. Berkshire still generated 2% alpha during this period. And third takeaway is that because of Berkshire's lacking exposure to the AI revolution, if we want to get exposure to this field, we need to invest in this sector separately by investing Berkshire as well as S&P 500 or combining Berkshire with QQQ or selecting individual stocks that we want to include to our portfolio. Because I'm a full-time fund manager, I personally take third approach where I select individual AI stocks to invest in. You can also take a look at these research reports where I value each of the AI companies through the link below. Going back to the analysis, even though we are expecting Berkshire's equity portfolio to not generate huge alpha going into the future, investors should not be disappointed because the second, insurance business, has a way to compensate for this bad news. Berkshire's insurance business by premium is one of the largest in the world, but by its capital, it is the largest insurer in the world. And in order to see how this is helping the shareholders of Berkshire, we need to understand the concept of cost of capital. Cost of capital indicates the cost of financing the assets that the company has. We can either use liability or equity. And usually, equity investors require 9 to 11% return because this is what they can expect by investing in public equities over the long period of time. And debt investors usually require between 3 to 7%. So if the asset generates 10% return, and say we bought the asset by $100 million, then each year the company will generate $10 million. And because here we will use the leverage, let's say we borrow $60 million and pay 5% interest. So each year the company pays $3 million of interest expense. And so the equity investors will fill in the $40 million, and because the asset generated $10 million and paid $3 million in interest, shareholders get $7 million per year, which turns out to be 17.5% return. So even though the asset itself only generates about 10% return, because we are using the leverage effect, in other words, we are lowering the cost of capital by utilizing the liability, which only costs 5%. So as a result, the shareholders can generate higher return than the asset itself. So let's take a step back and see how equity investors can increase their earnings. First, it's generating higher profit from the assets. Instead of 10%, if we can generate 20 or 30, equity return will increase. This is what everyone is pretty much focusing on. As we saw in the equity portfolio example, and also how the market focuses on how Buffett generates profit from investing in stocks, say through the Apple stock. Everybody knows this simple method to increase the profit. However, the second method and the secret of Berkshire's insurance is that it's lowering the cost of liability. So in the example before, instead of borrowing at 5%, if we can borrow at 3 or only at 1%, we can significantly increase return to the shareholders. So this is the cost of capital concept. Let's see how it applies to the insurance business of Berkshire. For those who don't understand insurance business, I'll explain it very briefly here. Here, there's an insurance company and a hotel, and this hotel wants to insure itself from the hazard of fire. So it gets into a contract with the insurance company and pays fee each year. So in this case, let's say it pays $1 million per year. So the insurance company will hold this $1 million, and in the second year, if there is no fire, the hotel will pay another premium, so the insurance company will be holding $2 million. So let's say this goes on for 5 years, and then there is a fire happens at the hotel. So now the insurance company has to pay for the damage of the fire. And let's say the damage cost $4 million. So in this case, insurance company received $5 million but paid back $4 million. So this $1 million is its underwriting profit. However, if the fire was bigger, and say the insurance company had to pay all the $5 million, insurance company broke even in terms of underwriting. And in the last case, let's say instead of 5, the insurance company had to pay back $7 million. In this case, this $2 million will be underwriting losses. There's the second method, how insurance company can generate profit. And that is, while it's holding that $5 million before the fire, that $5 million is called float. And in Buffett's own word, this is money that the insurer holds but does not own, because it will probably have to pay back the money to its customers. And while it's holding this float, it can invest in stocks or bonds and generate profit. So this investment return is the second way where insurance companies generate profit. So the two ways insurers make money is through underwriting activity as well as investment activities. most insurance companies only break even through this underwriting activity. So combined ratio is how we usually measure the profitability of underwriting, and 100 is break-even point. So usually they make a little bit of profit or a little bit of loss during the most year. However, if you look at the Berkshire, in its recent 20-year history, its combined ratio was only 94.7, which means it generated significant profit from the underwriting activity. And if we apply to the diagram that we saw before, normally companies have to pay interest expense in order to take hold of this capital. However, in Berkshire's case, it is actually getting paid 5% while holding this money and investing the capital. And if you look at the long-term trend, this combined ratio is actually decreasing compared to the past because of large economies of scale, which we'll discuss further in the later part of the video. But basically, Berkshire's insurance business generates higher profit than its peers. And this is the same with the investment return. And this is not just because Buffett can invest better than other insurance companies. Normally, insurance companies invest heavily into bonds and only invest about 10 to 20% in equities. However, in Berkshire's case, they invest 40 to 50% in equity. So it's much easier to generate higher return in this structure. But here we can ask, why don't other insurance companies follow the same suit? And let's take a look at how Bill Ackman describes Berkshire's insurance business. He says that because Berkshire only uses low leverage, which means they're very conservative in terms of their underwriting activities, and also because Berkshire has other businesses other than insurance, they have higher stability, so they can invest higher portion of their capital into the stocks. Obviously, this is not an easy thing for other insurance companies to copy, so this advantage of Berkshire will continue into the future. Now, let's take a look at how Berkshire's liability, or float, has performed in the past. As we can see here, the float has grown very well, about 7% per year, but its insurance business started out very small in 1967 when Buffett acquired National Indemnity, which is a small insurance company. And through the large acquisitions in 1996 and 98, Berkshire started to become a major player in the insurance world. And it continues to acquire insurance companies throughout the years, and continue to crank out capital through the structure that we saw before. And currently, Berkshire's insurance business can be divided into 4 parts. Walking through each of them in detail will take us such a long time, so here I wrote down the description and just discussed the key point. Geico is an auto insurance company where they sell directly to customers. And second part is Berkshire Primary, which is a collection of niche independent insurers, which has focus in the US. And third is the reinsurance business, which specializes in very large, complex insurance policies. And this part is very significant and profitable for Berkshire. And this is possible because of Ajit Jain, whom Warren Buffett compliments pretty much every year for the past several decades. And fourth is General Re, which is more traditional global reinsurer, which is decentralized and has more global presence. So basically, Berkshire's liability is increasing at about 7% per year. And instead of costing the company, it is generating about 5% of profit. So even though the Berkshire's assets, let's just assume that it's equity holdings, which generates about 10%. And because of the boost that comes from this liability structure, Berkshire's equity holders can generate much higher return. In this numbers example, which can go up to 25%. So some important lessons here is that Berkshire doesn't have to generate high return from its stock investment. And its insurance business still has bright future going forward because of economy of scale. And lastly, as Bill Ackman mentioned, there's indirect benefit of its non-insurance business because it increases its economies of scale and the stability of the overall structure. Which leads to the third arm of Berkshire, which is called MSR, Manufacturing, Service, and Retail. This collection of businesses started in 1972 when Buffett and Munger acquired See's Candies for $25 million. And since then, they continue to buy various companies, and this MSR now comprises over 60 subsidiaries. And by revenue, this is the 44th largest company in the world and 20th largest in the US if this MSR segment was an independent company. Even though it's big size, it has still decentralized management system. So these are 2 characteristics of MSR. And third is that it's not just collection of businesses, but these investing legends have collected for over 50 years only the companies that they want to own forever. And in the past, in his shareholder letter, Buffett described the type of companies that they will acquire, which has significant size, consistent earnings, good ROE, management in place already, with simple business model and a clear, cheap, or reasonable price. Here, a key differentiator is the management in place. Because normally, when someone acquires a company, they want to take full control of its operations. However, in Berkshire's case, they let the existing management continue to run the companies unless special occasions arise. So even when the company has good economics like Buffett describes here, they were still willing to sell to Berkshire at a reasonable price because of this fourth criteria. Now let's take a look at MSR in numbers. This is the sector exposures of the company. Manufacturing is about 60%, service 20%, and retail and consumer staples each contribute about 10%. So even though the businesses are focused in the US, it is well diversified into various sectors. And Berkshire discloses its performance each year, but if you look at the long-term trend, we can see that its profit increases about 10% per year. So this is not a phenomenal number, but we can see that it's very stable with satisfactory growth rate. So here we can see that the MSR is a pretty good cash cow for Berkshire Hathaway. And fourth piece of the company is utilities, which includes railroads, comprised of 3 electric utilities, 5 gas pipelines, with import-export facilities of natural gas, and 10% of its assets invested in the UK or Canada. And utilities are obviously generating very safe earnings, and at the same time, this business is growing at about 5 to 10% per year. And in terms of its railroad business, I created separate videos on the economics of railroad companies in North America. So if you're interested, you can check out this video. And here we will talk about BNSF, which Buffett acquired in 2009. The timing is important because this is during the panic of the 2008 financial crisis. So when the market was in panic, Buffett was able to deploy billions of dollars and acquire this company. And he paid $44 billion, of which $10 billion was in debt, and only paid 6.5 times in its EBITDA multiple. And if you look at the actual financials since the acquisition, by now, the free cash flow the company generated already exceeds the enterprise value of $44 billion. And even though the company started paying dividend in 2015, the amount it paid so far is close to the purchase price that Berkshire paid. And because it pays about $4 billion per year, and Berkshire deployed about $34 billion in equity, the dividend yield comes out to be 12%. And one of the weaknesses of this business is that its growth is only about 3 to 5% per year. However, because we are getting paid 12% per year in dividends, we are probably okay with slower growth coming from the railroad business. So these are the 4 pieces of Berkshire, and let's see how each of them interact. First is insurance. It continues to generate its float, which gets larger and larger each year. And this capital, as well as the equity, can be deployed into these 2 highly cash-generative businesses, as well as public equities. And whenever there's cash generated from these assets, for example, when public equities pay dividend or there's sale of stocks, the money goes to the holding company at Omaha. Similarly, when those dozens of MSR companies pay dividend, that money goes to the holdings company as well. And finally, utilities also generate high level of cash, but Berkshire prefers to reinvest in those companies rather than taking out those cash because utilities generate very stable 10% ROE. Anyways, when this cash goes to Berkshire Hathaway, they pile up. And Berkshire has several options to deploy this capital. First is they can acquire new insurance companies, making the float even larger. Or if there's good opportunity in public equities, they can buy stocks. But like currently, if the public stocks are too expensive, they can do M&A or invest more capital into the utilities. And lastly, if Berkshire's own stock price becomes too low, it can buy back its own shares as it has done in the past years. So basically, when we invest in Berkshire Hathaway, instead of investing in these individual companies and businesses, we're investing in this holdings company where the capital is deployed where it can best generate profit. And as we can see here, there are various options that the managers can use. And if I have to pick the highlight of today's analysis, this is probably the most important part. The first is that Berkshire does not have to generate significant alpha from its equity portfolio in order to do well. And because of the economies of scale factors, despite many people worrying about the company being too big, due to the lowering cost of capital through insurance business, it can still generate very stable 10 to 12 or even slightly higher return over a long period of time. But here, if we step back, if Berkshire generates about 10 to 13% of return, it's actually quite comparable to the market return. So why should we go through this headache of analyzing and considering investing in Berkshire. That's because of the valuation that we saw before. Because the market is so expensive right now, just by the S&P 500 returning to its median multiple, the market can crash easily more than 50%. However, if Berkshire returns to its long-term median, it will decrease only 11%. So if both assets generate about 10 to 12% return over the long period, going with this lower risk option seems to be a very logical thing to do at current market condition. Borrowing Buffett's own word, is only when the tide goes out that you discover who's been swimming naked. So I'm not saying the tide will go out tomorrow or even next year, but when it does, the people who are numb to the risk factor will lose significant amount of money. So that sums up the second analysis on Berkshire, and next analysis will be about the intrinsic value of Berkshire as well as major risks and investment strategy regarding Berkshire. Thanks for watching today, and if the video was helpful, please click the like button and subscribe to the channel.